Okay, guys, now we're gonna hop into our second lesson. This is gonna be on the different forms of liquidity. When we identify where buyers and where sellers are entering, that's a form of liquidity, right? And again, these all come from different retail concepts out in the space that we view as liquidity. We're gonna cover all these different forms in this lesson here. Why liquidity takes different forms. Liquidity forms as a direct result of how traders are taught to interact with the market. I believe all of these retail concepts out in the space, whether you're looking at breaking retest, support and resistance, Fibonacci, all these different things, they all work temporarily, but they work temporarily for a reason, right? Now, understand this, if these retail systems, these retail concepts never worked, why would traders use them? That's why they work sometimes, okay? So it's our job as the traders that trade this system here to identify where and why they are entering, and then we identify that as liquidity and use that to our advantage. This is why liquidity forms around familiar ideas rather than random price points. Where price behavior repeats, money repeats. Where money repeats, liquidity builds. Once enough liquidity exists in one area, the market is able to use it as fuel for movement. Understanding this shifts the focus away from finding the right concept and towards understanding how collective behavior shapes where liquidity exists. Market structure as our liquidity framework. Okay, guys, this is gonna be the bread and butter of how I view liquidity. Okay, so listen up, lots and lots of powerful stuff here. Market structure teaches traders how to identify higher highs, higher lows, lower highs, and lower lows. A very, very common retail concept, okay? I'm sure maybe a lot of you guys maybe even trade it right now, or you did trade it in the past. These labels become the foundation for how traders define trend, bias, and direction. As a result, almost every retail concept, regardless of its name or strategy, uses structure as the framework or decision making. Whether traders are aware of it or not, structure becomes the reference point for entries, exits, and risk management. Market structure as a liquidity framework continued. Because market structure is used to define bias, traders naturally place their stop losses beyond structural points. Highs, lows, and perceived invalidations become areas where risk is defined. So anyone in here right now that is a structure trader, or you did in the past, you probably realize now or in the past that usually there's times where you'll take a trade based off a structural point, and then it ends up running that structural point and then just continues in your intended direction, okay? That's the moves I'm looking to catch, okay? When those structure traders are confused and they're like, oh, my sell got taken out as a loss, but the market continued selling off. Okay, those are the moves I'm usually looking for. As more traders rely on same structural logic, stops begin to cluster in the same locations. Over time, these structural levels stop being just reference points and become pools of liquidity. Okay, those are the levels we look to trade from. This is why structure works, not because it predicts direction, but because it organizes behavior. It funnels trader activity into specific areas of the market, causing money to accumulate around certain highs and lows. Okay, very, very important. This market is not reacting to structure as a concept, it is reacting to the liquidity that structure creates. Once those structural stops are triggered, liquidity is released, giving price the fuel it needs to transition into its next phase, which will typically be that big move, right? That expansion higher or lower. Understanding structure this way removes the illusion that it is predictive. Instead, it becomes a map of where money is resting. Structure does not tell the market where to go, it shows the market where liquidity exists. Next, we will break down the different forms of retail liquidity. As you go through them, one question should always remain in the front of your mind. Where are the stop losses? When you begin to look at that market through this lens, the behavior behind each concept becomes clearer, okay? And that's the perspective I want you guys to have moving forward. If you do go through with this system and you do enjoy it, it does resonate with you, understand this. Going forward, you always want to show up to the charts and have that perspective. Look through that lens that you want to be able to identify where are the stop losses, okay? Where are the buyers in the market? Where are sellers in the market, okay? And we want to be trading once the buyers are taken out, or on the flip side, once the sellers are taken out. You will start to notice that market structure, which serves as the backbone for most retail trading approaches, is ultimately a mechanism for liquidity creation, okay? Once that connection is understood, structure stops being a predictive tool and becomes a clear representation of where liquidity is resting in the market. breakouts as a form of liquidity. So we're going to go into the different forms, okay? First area we're going to hop into is breakouts, okay? So it represents one of the most common ways liquidity is created. Traders are taught that when price breaks a level, continuation will follow. As a result, buy stops and sell stops accumulate behind key levels. The breakout itself is not the edge. The liquidity it creates is what matters, okay? Here we have a chart example to the right-hand side. You can see an area of resistance, okay? If you follow my red line right here, right? Building liquidity above these highs. Very simple. Now, traders typically will take that entry as soon as those highs are taken out, whether that's a buy stop in this example, because again, we're looking at breakout traders. So they'll have their buy stop set right here. The market will move up in the direction, tag their buy stop, and they think the market is just going to continue forever and ever and ever. Now, understanding that is important, but now you need to ask yourself, where is their liquidity going to be formed? And I have it marked on for you guys right here, down at this low, and of course, down at the lows at the very bottom, okay? So this is what we call just a normal breakout kind of trade. So here we have more breakout examples. Always return to one question. Where are the stop losses? Okay, like we've been talking about here. As you start paying attention to this, it becomes clear that most retail concepts concentrate their risk in the same locations. So look at this, a bunch of lows being built up, so liquidity in our eyes. The market sells off. There is the retail sell stop activated, and now they're in their short positions. Okay, they want to see price all the way back down to the downside. Here's going to be liquidity, and of course we have stop losses resting at the highs as well. Now we have break and retest as liquidity creation, probably one of the most common retail concepts out there. During a break and retest, traders wait for their price to return to the level before entering. Okay, when they enter, they define their risk around the most recent structural high or low. This means stop losses are placed just beyond the structural point, not at the retest level itself. As more traders participate, liquidity accumulates beyond the structural high or low. At this point, liquidity now exists outside of price. The market has two options. It can leave that liquidity untouched and move away to access it later, or access it right away in order to fuel the movement in the intended direction. Okay, so mouthful right there. But again, if we look over at the chart over here to the right-hand side, we have another example built for you guys. You can see we have resistance of some way, shape, or form building here. Now, typically what the break and retest trader will do is wait for the market to come back down, retest this red box, retest this zone, you'd call it, and then they enter here, and they want to see the market continue again forever and ever, right? All the way back up to the upside. Here is going to be stop losses, and again, more stop losses down at the lows. Okay, so very simple, very straightforward. Again, this is probably one of the most common retail concepts out there. Here is more on the break and retest. So always ask yourself, where are the stop losses? As you start paying attention to this, it becomes clear that most retail concepts concentrate their risk in the same locations. So look how we have written it here. Price broke support level, strong bearish close. They want to see a slow correction retesting the support, and then lower prices. So here's that slow correction. Okay, now they want to be entering here as their break and retest, and they want to see price all the way back down to the downside. Stop losses, same thing. And now we are going to move on to trend lines. Okay, another very common retail concept. Trend lines are another form through which liquidity forms. Traders use trend lines to enter, exit, and trail stops. As price respects a trend line, confidence grows and participants increase. Stops begin to stack along, and just beyond the line, over time, the trend line becomes less about direction and more about where liquidity is resting. So here we got an example for you guys again. Trend line trading uses diagonal support or resistance to guide entries. Okay, I've never been a big fan, even in my early retail concept trading days when I was trading all these systems and I wasn't finding results. I never understood why the trend line was a tool that was used for people to trade, right? You can kind of draw it anywhere on your chart. And right then and there is when I figured like, this is not going to be for me. So traders typically take setups on the third touch of the trend line, which stops placed just beyond the trend line. Example being these photos right in front of us here. So we have one touch, two touches, three touch. We have the trend line traders entering positions right here. Okay. Stop loss is going to be resting below previous lows. Very simple. Okay. And on the flip side, we have one touch, two touch, and here's your third touch. Stop losses are going to be resting above that high. Nothing too complicated here. Just understand, you always want to have that perspective, is where are the stop losses. So here we have another trend line in front of us. We have one touch, two. You can say this is another touch here. Here's your third. People are entering here. People are entering here. Okay, so stop losses are going to be resting here. And even in this example, you can say they're resting above these highs as well. Okay, but here I have it marked on for you already. The red diagonal line identifies where stop losses are going to be. Okay, so look how the market even reacts off this trend line once more. Look at this reaction from high to low. Okay, when it's tapping this trend line, it is building liquidity to the upside. Now we're going to go into another form of liquidity that is probably very common in the industry nowadays, and that is going to be SMC concepts as liquidity builders. So SMC introduces ideas such as order blocks, imbalance, and points of interest. While these concepts are designed to explain market behavior, they are strongly influencing traders that choose to enter and where they define risk. In practice, this results in stop losses being placed around structural highs and lows. Okay, remember what we talked about before, causing liquidity to accumulate in those areas. The concept itself is not what matters most. What matters is the behavior it produces. As traders act on the same ideas and manage risk in similar ways, liquidity naturally forms around the same structural levels. And you guys will notice this more and more as we go forward, that basically all of these retail concepts just come back to structure. These are things you're going to notice as we move forward with these lessons. So here we have in front of us more SMC examples. Okay, so we're going to go through the first example on the left hand side. It's going to be a diagram to make sure you guys understand everything first, but here we are. Smart money concepts focus on structure, key levels, aka POI, and institutional order flow is what they call it. So in this example here, we have a bunch of higher highs and higher lows. Look how the market moves bullish here, taking out a previous high. There is a POI down at the lows. This is where typically SMC is entering positions. Okay, uninformed SMC traders will be entering positions, leaving liquidity for us at the lows. Okay, and then look how the market trends higher, takes out another high. Okay, price comes back down to the low, respects the POI, and look at that. We move bullish back up to the upside. Now, if you take your eyes from the diagram and now we move over to a chart example, we have a chalk, people call it, or a BOS to downside. Now, traders will be entering positions here. So, form of liquidity at the highs. And then look how we get a big sell-off to the downside and the market slowly starts correcting its way back up. Look at this choppy. This is all done for a reason, because it is telling uninformed market participants that the bullish momentum is dying, right? And they want to see us sell back down to the downside, okay? But we understand this is where SMC traders are entering positions. So there's going to be stop losses above the high here. And again, stop losses above the high here. So that goes back to what we were talking about earlier in the lesson. That's the perspective you always need. Where are the stop losses going to be? All right, so now that we've gone over different types of retail strategies, what can we actually conclude from all of this? Yes, we now have a clear understanding of where retail stop losses are typically placed. But the deeper reason for studying these strategies goes beyond identifying stop locations. No matter how many strategies are introduced or repackaged over time, they all orbit around the same foundation: market structure. Structure is the framework traders rely on to identify trend, direction, and risk. Whether the strategy is a breakout, retest, a trend line, a smart money concept, structure is what tells traders where they are wrong. This is why stop losses consistently end up in the same areas, around structural highs and lows. This is what turns structure into liquidity. To structure, capital concentrates around the same levels. When enough participants behave the same way, structure stops being a visual concept and becomes a functional liquidity map, we can call it. Understanding this shifts your perspective entirely. You're no longer looking at strategies as signals to follow, but as behaviors that create liquidity. And once you see structure through that lens, the market becomes far more logical, intentional, and readable. Okay, so here we have another retail liquidity example in front of us. Quick reference for you guys is these red boxes are all used as traps, okay? Levels, zones, areas that we expect the market to react to, okay? But it's only gonna be building liquidity, okay? So look at this. We have a BOS to downside for retail. That tells us structure traders are gonna be entering here, here, okay? Even up here, even up here. Look how we get reactions out of all of these areas, okay, temporarily, okay? What do I mean by that? Look here, high to low, okay? And then back at the highs, look how we react from high to low from this zone. And then again, over here, there's another, probably a lower time frame refinement in this area. The market reacts high to low, but overall, we keep continuing back up to the upside. So here we go on the flip side. You can see how the market has taken out highs here, inducing buyers. Okay, there's that BOS for retail. And then we eventually come back down to the downside to take this low out. Here's another BOS for retail. Okay, so Since we took out this high here, I'm gonna clear these drawings up a bit. Since we took out this high here, that tells us buyers are interested in buying this thing back up. So look how we have reactions here, reactions in here. Finally, we take them out. Okay, so those people that were trading this BOS here, they have been taken out of the market. Now we want to participate. But look at it on the flip side now. Since we had this big sell move from high to low, sellers want to be selling this market. Okay, so where is their liquidity going to be? Back at this high. Okay, and look at this red box. Again, all these red boxes, areas of traps, reaction, and then overall, we get that continuation higher. So here we have another example in front of us. We have the market taking out this low here. Again, here's that BOS for sellers. Okay, they think we have a market structure shift to downside, so they want to be selling these areas here, maybe in here, over here. Okay, failing to understand that liquidity is to the upside, and look how they keep becoming that liquidity. Okay, if they're entering here, they're building liquidity at the highs for us. If they're entering here, they are building liquidity at the highs for us. Okay, and ultimately the market just continues back up to the upside. So that concludes module 2, aka lesson 2, on different forms of liquidity. If you guys missing a couple things, please rewatch this video. This is again just focusing on why the market is building liquidity, okay, using different forms. All right, so again, we have that breakout, we have a break and retest, trend line, smart money traps. All of these different concepts end up coming back to structure. And again, the more we go through these lessons, you guys will see that.